Here's a question nobody asks. If someone correctly predicted the two biggest stock market crashes of the 20th century, made the equivalent of nearly $2 billion in modern money, and was personally considered so dangerous that one of the most powerful bankers in the world once called him and begged him to stop, why did that same man die with nothing? Not less than he had. Nothing. Bankrupt. Alone. And by his own hand. Because this isn't a story about a man who failed to read the market. It's a story about a man who read the market perfectly and still managed to destroy himself completely. His name was Jesse Livermore, and I'd argue he's the most important figure in financial history that almost nobody talks about. Jesse Livermore was born in 1877 in rural Massachusetts to a farming family with no money and even less opportunity. At 14 years old, he ran away from home with $5 in his pocket and got a job posting stock prices on a chalkboard at a brokerage firm in Boston. While other kids his age were playing outside, Jesse was memorizing price patterns. He wasn't studying fundamentals. He wasn't reading annual reports. He was watching numbers move and noticing something nobody else seemed to notice, that stocks didn't just move randomly. They moved in patterns, and those patterns repeated. By the time he was 15, he had turned that $5 into over $1,000 trading in what were called bucket shops, basically illegal betting parlors, where you could wager on whether a stock price would go up or down without actually owning the stock. By 20, he had been banned from nearly every bucket shop in New England, not because he cheated, because he kept winning. This was the beginning of what should have been the greatest financial story ever told. Fast forward to 1907. The U.S. banking system was on the verge of collapse. Credit was drying up. Banks were failing, and most investors were either frozen in panic or desperately holding on to positions and praying. Jesse Livermore did the opposite. He shorted the market, meaning he bet that prices would fall, and he did it aggressively. By the time the crash hit, he had made $3 million in 1907 money. That's the equivalent of roughly $100 million today. He was so profitable that J.P. Morgan, yes, that J.P. Morgan, personally called Jesse and asked him to stop selling, because Livermore's short positions were accelerating the panic and threatening to make the crash even worse. Jesse agreed to stop, not because he was scared, because he had already made enough. Think about that for a second. One of the most powerful men in global finance called a 30-year-old trader and asked him to please stop making money. That's not a career. That's a superpower. And then he lost it all. Not once, 3 times. Between his great wins, Jesse Livermore went completely bankrupt. Bad real estate deals, reckless speculation on cotton markets, a business partner who defrauded him, and his own inability to follow the rules he had written for himself. Because here's the thing about Jesse. He knew what he was doing wrong. He had literally written down his own trading rules. Don't overtrade. Cut your losses early. Never average down on a losing position. Don't let emotions drive decisions. He knew the rules. He just couldn't follow them. And this is where the story stops being about the stock market and starts being about something far more uncomfortable. Then came 1929. By now, Jesse had rebuilt his fortune multiple times and lost it multiple times. But in 1929, he outdid everything he had ever done before. He saw the same patterns he had seen in 1907. Overextended valuations, reckless lending, blind optimism dressed up as genius. Sound familiar? He spent months quietly building one of the largest short positions in market history, and when the market crashed on October 29th, 1929, Black Tuesday, the single worst day in stock market history at the time, Jesse Livermore made approximately $100 million in 1929. Adjusted for inflation, that's somewhere between $1 and $2 billion in today's money. His wife was reportedly so afraid of public reaction to his profits during a national catastrophe that she kept a revolver in her nightstand. He was the most hated man on Wall Street, and the richest. And then, once again, he lost it all. By 1934, just 5 years after his greatest triumph, Jesse Livermore filed for bankruptcy for the 3rd time in his life. He listed debts of $2.2 million. He couldn't explain it. He had written about discipline. He had lectured about emotional control. He had told anyone who would listen that the market always wins against impatience and ego. And then he proceeded to trade with impatience and ego until there was nothing left. On November 28, 1940, Jesse Livermore walked into the cloakroom of a hotel in New York, sat down, and shot himself. He left a note for his wife. It read, "My life has been a failure." The man who had made and lost 4 separate fortunes. The man who had predicted both the crash of 1907 and the crash of 1929. The man J.P. Morgan had personally called and asked to stop winning, called his life a failure. So here's the question that should be keeping you up at night. How does someone who is right, genuinely, historically, provably right, about the biggest financial events of an entire century end up with nothing? The answer isn't bad luck. It isn't bad information. It's something far more disturbing. Jesse Livermore's greatest enemy was never the market. It was the 6 inches between his own ears. Because the same brain that could read patterns across thousands of stocks, that could sense when a market was lying, that could hold a short position through waves of panic while everyone else was buying, that same brain was completely incapable of managing his own psychology. After every big win came overconfidence. After every loss came revenge trading. He broke his own rules, not because he forgot them, but because he genuinely believed he was the exception to them. Psychologists call this the illusion of control. The more success you've had in a complex system, the more you start to believe your success came from skill alone, and the less you respect the role of risk. Jesse Livermore spent 40 years confusing being right with being safe. And the tragic irony is that the market gave him every warning. He went bankrupt 3 times before the end. 3 separate chances to stop, to reassess, to acknowledge that his psychological vulnerabilities were as dangerous as any crash he ever predicted. He ignored every one. Now, here's the part that makes this more than just a history lesson. Because Jesse Livermore's story is repeating right now, not as one man, but as millions of them. Every bull market creates a new generation of traders who confuse luck with skill, who confuse a rising market with personal genius, who write their own rules and then immediately break them, who make money once, twice, 3 times, and then give it all back with interest. The market doesn't care how many times you've been right before. It only cares about right now. And the cruelest truth in all of finance is this: the skills that make you rich and the skills that keep you rich are completely different skill sets. One is about reading the world. The other is about reading yourself. Jesse Livermore was the greatest at the first one who ever lived. And he never learned the second. He called his life a failure. But I'd argue his life was actually a warning. The question is whether you're listening. If this story changed how you think about money and psychology, subscribe to this channel.